Episode 3. Third time's a charm. 3 years of residency training to become a family doctor in the US. 3 ossicles or bones in your middle ear. 3 strikes and you're out. 3 years to double your money if you can earn 24% return year over year, which is not happening anytime soon for me. 3 periods in our great game of hockey. 3 shots until I'm drunk, which is pathetic. Why am I telling you all this? I have no idea, but it's too late. Episode 3. Here we go. Welcome, everyone, to the third episode of the Beyond MD podcast. Today's episode focuses on structuring and optimizing corporate investments and understanding how these are taxed. Today's interview, we have a very special guest, Jamie Golombek from CIBC, who is a true tax expert. But before we get to the interview, we need to spend about 5 minutes tackling a few concepts. So, first thing, let's do a quick recap. As professionals and small business owners, what's the main reason that we incorporate? Well, it's for the tax deferral. So let's take a few numbers here. Top marginal tax rate in Ontario is about 53.5%. The same rate holds for BC. I mentioned BC because I have a lot of love for BC. Did 4 years of med school out there. In fact, I have a lot of love for all of Western Canada. Spent a year working in Calgary, Alberta as well. But anyways, let me reel it back in. 53.5% top marginal tax rate in Ontario. In contrast, what's the tax rate on the first $500,000 of corporate income in Ontario? 12.2%. So as you can see, there's about a 40% tax deferral advantage. Okay, so you've got some money in the corporation. Now we need to go ahead and invest it. But in order to invest it in a tax efficient manner, we need to understand how our corporate investment income is going to be taxed. So let's first take a look at capital gains. And to illustrate this, I'm going to use an equity that I wish I owned, but I don't, and that is Shopify. So Shopify is a Canadian tech company that doesn't pay a dividend. So let's say you go ahead and buy a bunch of Shopify stock, and that over 5 years it appreciates 200%. So if you sell that stock, then you've realized a capital gain of 200%. Okay, what happens to that income? That is going to be taxed. How? Half the capital gain will be taxed at 50%. Then you can take that money and reinvest it through the corporation, or you can try and move it to yourself personally. If you move it to yourself personally, that's going to be in the form of a taxable dividend. But when you're doing so, you get part of that initial tax hit back. How much? 30.67%. How does that happen? Well, it happens through a hidden notional account in your corporation called the RDTOH, which stands for the Refundable Dividend Tax on Hand. If you don't understand this right away, not to worry, we are going to cover it in a bit more detail later on. So why does this refund happen? Well, it's just in support of the principle of tax integration. And all this means is that investment income is meant to be taxed at approximately the same rate, regardless of whether you make it personally or through a corporation. But as we're going to see, this system is not perfect. Okay, now for the best part. What happens to the other half of the capital gains? Well, it's tax-free. It flows into the second notional account in your corporation called the CDA, the Capital Dividend Account. And you can make payments to yourself personally tax-free from the CDA as long as the net value in there is above zero. Okay, now let's look at other types of corporate income. So Canadian dividends, interest payments, and foreign dividends. And I break them up like this because each has a slightly different tax treatment. For Canadian dividends, let's take Enbridge as an example. So Enbridge pays a quarterly dividend. Every 3 months, money goes into your corporate investing account. And then what happens? Well, it's taxed. At how much? 38.3%. So you can take that money and reinvest it through the corporation, or you can try and move it to yourself personally. Now, if you try to move it to yourself personally, that's again through a taxable dividend, but when you do that, you actually get the initial 38.3% tax hit back entirely. So basically, Canadian dividends have favorable treatment inside a corporation. Now, let's go to interest payments. They're initially taxed at about 50%, and when you move the money to yourself personally, you get 30.67% back. Foreign dividends, unfortunately, are a bit of a different animal. They're subject to more clawbacks, most notably the foreign withholding tax. Basically, you get less of the initial tax that refunded to you, and therefore you're going to keep less of that foreign dividend income. So just remember, all these partial refunds for Canadian dividends, interest, foreign dividends, they all happen through that notional account, the RDTOH. Okay, So, what does this all mean? Basically, capital gains are treated favorably inside a corporation. But let's get one thing straight. I am not telling you to avoid investing in good foreign companies that pay a dividend. Let's take Microsoft and Nvidia, for example. These are both great companies, and you're probably not investing in them strictly for their dividend income. And over the long term, good companies like these are probably going to have some capital gains. But the point I'm trying to get across is that when you do try to move foreign dividend income to your personal hands, well, just realize that due to less favorable tax treatment, you're going to be keeping less of that money. So now the final thing we need to talk about is the impact of corporate investment income on the small business limit. So all of your investment income in the corporation falls into this term called the AAII, and that stands for the aggregate adjusted investment income. So, and that includes interest, realized capital gains, dividend payments, rental income, and any gains from your insurance policies. So, if that total investment income in a year exceeds $50,000, well, then in most places in the country, you're going to start to bring down your small business limit, such that every dollar of corporate investment income in excess of 50,000, your small business deduction will fall by $5. So once you hit $150,000 in total corporate investment income, which kind of seems like a pipe dream to me now, but hey, you never know, maybe one day, well, then your small business limit will effectively fall to zero. Why is this a big deal? Well, let's take a look at British Columbia, for example. So, corporate income that falls into the small business limit achieves a tax deferral of just under 38%, whereas corporate income in excess of the small business limit achieves a tax deferral of just under 23%. So you can quickly see the impact of a decline in your small business limit. Now, Ontario and New Brunswick are apparently exempt from everything I just said. Why? I have no idea. But to help us answer these questions and more, we are very lucky to have Jamie Golombek today. Jamie Golombek is Managing Director for Tax and Estate Planning with CIBC. He joined CIBC in 2008 after 12 years with a global investment company. And he also spent time in Toronto's Deloitte office as a tax specialist in corporate and personal tax matters. Now, Jamie is quoted in the media as a tax expert, which he absolutely is. In my mind, Jamie is one of the most up to date and respected voices when it comes to helping professionals with corporate and personal tax matters. Jamie writes a weekly column for the National Post called Tax Expert, and he's been writing for the Post for the last 18 years. Jamie is also a past chair of the Investment Funds Institute of Canada's Tax Working Group, and if he doesn't do enough already, he also teaches an MBA course in personal finance at the Schulich School of Business. So here is my interview with Jamie Golombek. Jamie, great to have you with us today. Where does this podcast find you?
Well, I am located in my home office now in Toronto. I've been working from home since the pandemic started on March the 12th, and there are no plans to return anytime to downtown Toronto, Bay Street, because of the pandemic.
Well, it sounds like you're making the most of it. And Jamie, we might as well just hit the ground running here. And the first question I want to ask is because some questions have been arising about this topic, and that is on the prescribed rate loan. And while it's a fairly straightforward topic to grasp, one thing I did want to clarify is that the prescribed rate loan is only something that can be made with after-tax non-corporate dollars, correct?
That's very plain and simple. That's correct. Yeah. I mean, there's all kinds of issues if you start loaning money from a corporation, including a professional corporation. You basically have an income inclusion because of shareholder loan rules. And what the government is trying to do is avoid the obvious planning idea where you earn all your income inside of your corporation and you just loan it to yourself forever. Uh, so they don't want you to do that. If you do that, there's an income inclusion. You have to include the entire loan in your income, and you get a deduction later on when you pay it back. So even charging the prescribed rate doesn't work. So no, it has to be when you've heard the idea of a prescribed rate loan, you're looking at non-corporate dollars for the loan.
Okay, I just thought I'd clear that one up right away before I do something really stupid with my own corporate money. So I've done some calculations, and if you basically loan anywhere from $15,000 to $20,000 from yourself to somebody in your family who's at a lower marginal tax rate, and let's say that the delta between their investment return and the interest rate is around 5 to 6%. Well, it turns out that only really results in a few $100s of tax savings. And while that's great, it'll help me cover Starbucks for a few months. It's certainly not monumental. So my question is, to make the prescribed rate loan process worthwhile, what guidelines can you give us in terms of the amount that should be loaned and the differential required in the marginal tax rate?
Yeah, well, great question. So right now we're in a period between now and at least to the end of the year. They've confirmed the prescribed rate will remain at 1%, which means if you set up this loan now, you're good forever. For the duration of the loan could be 5 years, 10 years, could be a demand loan forever. So the differential now is fantastic because you've got that floor, that 1%. You can never get a lower rate than 1%, by the way, because it's
Hmm.
rounded up to the nearest whole percentage point. So you're at a great time to set up the loan. The question then becomes, what is the spread you need and what is the dollar amount? Traditionally, we've never seen one of these done. I mean, for the most part, we haven't seen every loan, of course, but the stuff that we've seen, minimum 500,000 to really make it worthwhile. And it also depends on what you're investing in on the other side. So, years ago when interest rates were higher and you were getting, 5 or 6%, which was, sort of a fixed income type rate, like many years ago, you get a guaranteed spread of 5%, and on 500,000, that's 25,000. Fantastic. Great opportunity there. Income splitting, for example, in a province like Ontario, where the differential between the top rate and the bottom rate is about 33%. You'd save, big bucks on 25,000, right?
Yep.
The problem is that most people are using these loans and they're investing in equities. And of course, with equities in a non-registered account, you're earning capital gains, hopefully, and those capital gains are deferred and they're 50% taxable.
Right.
So you need a 2% return just to break even on the prescribed rate, so 2%, at 50% taxable. 3, 4, maybe 4% or more. So half of 4% is 2, and you get deductibility of 1. You get a 1% spread. So you really have to be earning, more than 4, 5, 6% over the long term to make it worthwhile. So a lot of the strategies that we're doing right now with our clients are particularly using Canadian dividends. And the reason I say that, of course, is because of the dividend tax credit. Because if you can get a dividend yield on a blue chip portfolio of 4% or maybe even 5%, depending on the stocks that you're buying, take off the 1%, you've got about 3 or 4% spread. And on 100,000, 500,000, or $1,000,000, you could be talking about $30,000 or $40,000 of dividend income.
Right.
And if that prescribed rate is done, let's say, to children who are over 18, or if they're minor children through a family trust, then effectively what we can do is get dividends in their hands if they have no other income and not pay any tax. So in a province like Ontario and many other provinces, I think the magic number for 2020 is around 52,000 or so dollars. So that's because of the basic credit and the dividend tax credit. So it's a great opportunity to do your income splitting with someone with no income and effectively use their basic amount and the dividend credit rate to effectively get yield. So we're not primarily we're promoting a Canadian a diversified dividend portfolio for all of our prescribed rate loans, simply because of that spread and because you've got that sort of income versus that capital gain, which is already tax effective.
Okay, I think a diversified Canadian portfolio focusing on some dividends makes some good sense in that context. So, Jamie, let's move on to the bulk of the talk now. And I want to start off looking at investing through an RSP versus investing through your corporation. I know this is a topic that you and your team have written about over the years, and I'd like your current take on it. Perhaps we can divide it up into two parts. So, the first part, focusing on an individual who has a very balanced portfolio. What's the better route there, RSP versus corporate investing? And then the second scenario being somebody who is more focused on investing in equities that do not pay dividends and deferring capital gains as long as possible.
Yeah, I mean, we've done a lot of research on this. We've published some reports on this. We even changed our thinking, since we did maybe 8 years ago because rates have changed. Certainly in Ontario, we used to say, don't bother with RSPs. Corporations are the way to go. Keep all your income in there. Rates have changed a lot since our original research back in, I think, 2011 or 2012. And now we're generally of the view that in most cases, both RSPs and TFSAs will provide you more after-tax cash at the end of the day to the shareholder than investing corporately,
Hmm.
particularly if the shareholder uses the after-tax income that's not needed for an RSP contribution or for personal expenses. In other words, paying themselves out money every year anyway. And again, we've written about this. In terms of the portfolio, I would say that for the most part, I would say that safe to say, as you say, that a fixed income or balanced portfolio is best inside of an RSP,
Hmm.
because that really does well, and you're really avoiding taxes like in Ontario, 53.5%, Nova Scotia, 54%. So yes, I think that makes a lot of sense.
Hmm.
And we really are big fans of RSPs and TFSAs for business owners. With TFSAs, it's almost a no-brainer because, at the end of the day, you're not paying any tax on the investment income ever.
Right.
With RSPs, you are effectively paying tax, but you're earning a tax-free rate of return on the money inside of the RSPs. So unless you're, I guess, maybe 100% deferred equity capital gain portfolio, then you can sort of do the math and argue that maybe instead it would be better to leave the money in a corporation rather than to pay it out into an RSP. But I think if you're paying out income anyway that you need to live on, generating the RSP room, then I would go ahead and make the RSP contribution in almost every scenario that we've seen.
Okay, awesome. So it sounds like over the long term, a balanced portfolio that is earning different types of income, so interest, dividends, capital gains, is going to probably perform a little bit better in an RSP. But I just want to go back to the corporation now because a lot of us do invest through our corporations. And if I'm going to structure corporate investments, so I'll put a thesis out there now. So most preferable when investing through a corporation would be probably growth stocks that don't pay a dividend, where these capital gains would be deferred. I'd say next in line would be maybe equities in Canada that pay a dividend, so Canadian equities paying a dividend. And then lower on the list would be foreign dividend earning stocks given their tax treatment. Just tell me where I have this right and where I have this wrong. Do you generally agree with this?
Generally, except for your last statement. So we would generally avoid foreign dividend paying stocks ever inside of a corporation because of negative integration. We've actually published some research on this, and so have some of the other companies, that because of the way foreign income flows into a corporation, you can effectively end up with an extra 11% tax,
Hmm.
higher. I think that's the number in Ontario for this year, 11 or 12% more than if you had to earn that income personally.
Okay.
So generally speaking, I would agree with you. I would have number one, I would have 100% capital gains deferred equities in your corp. Then I would move to Canadian dividend paying stocks that have the capital appreciation and also Canadian dividends, provided you are paying those Canadian dividends out to yourself every year, so you don't pay that Part 4 tax.
Hmm.
And then finally, I would avoid actually all foreign stocks that pay foreign income because of the very punitive negative integration on foreign income in a Canadian corporation, no matter the province you live in.
Okay, and let's maybe look at that last point a little bit more closely because this probably wasn't as clear to me until I did some more reading on it. But let's look at the dividend income from a foreign equity. And let's say eventually you want to take that dividend income and move it into your personal hands. It sounds like the amount of tax that you're going to pay in that process is around 63%. Is that the right ballpark figure?
That's exactly right. So it's about 11%, 10 to 11% more, depending on the province. Certainly, I think that's correct for Ontario, than the top marginal rate. And that's because of an inefficiency on the refundable tax and the foreign tax credit. So you're absolutely correct. That's why we're saying once again that the foreign income on an all in tax basis is not tax effective and therefore should not generally be earned inside of a corporation.
Okay, Jamie, I'm really glad we're talking today because I know they call it lifelong learning, but based on what we've stated so far, it sounds like I need to make a few tweaks to the corporate portfolio. So, okay, so now we're talking about investing through the corporation. And I mean, the time is going to come when eventually we want to start moving that money into our personal hands. But I think in order to go through this process, it requires an understanding of the two notional accounts, the RDTOH, refundable dividend tax on hand, and the CDA, the capital dividend account. And while these concepts may be clear as mud to me now, it certainly took me a while to get my head around these accounts. And perhaps you can give us a quick summary on these two notional accounts.
Yeah, it's actually very straightforward. So RDTOH stands for Refundable Dividend Tax on Hand. And basically, what that does is it really adds up all of the refundable tax that you pay on the taxable portion of capital gains, on the interest income, and on the foreign dividend income that you earn. So effectively, the refundable tax is then refunded to you when you pay out a dividends.
Okay.
So their fundable tax, I believe the current rate is 30.666% or 30.67% rounded.
Yep.
And effectively, you get that back when you pay out a dividend to the shareholder. Now, there's been some recent complications with sort of non-eligible and eligible. I don't want to get into that. I mean, it's very, very highly technical. There's a few,
Hmm.
slight differences there. But I think that in a nutshell, the reason why we have a refundable tax is that otherwise all of us would just set up corporations to earn income and then just defer the tax on that until we paid it out to ourselves. And the
Hmm.
government wanted to discourage that. So they built in this refundable tax that's saying, you know what, you can earn investment income in the corporation, but until you pay it out, you're going to pay us 30% refundable tax, which is similar to the effective personal rate that you have when you pay that money out to the shareholder because you're paying dividend tax, you're getting a dividend tax credit. We're going to refund the amount to the corporation. So nothing to worry about in terms of RDTOH. For the most part, you are going to get it back to the extent that you can pay out your Canadian dividends every year.
Hmm.
That's the real concern. But the rest of it, there is a bit of RDTOH that you pay in there, and that sort of melds into the calculations of the integration advantage of a corporation. The CDA, the capital dividend account, is a lot easier to understand. The capital dividend account tracks the non-taxable portion of various items, including capital gains. So currently, as of when we're recording this on October the 19th, capital gains in Canada 2020 are taxable at 50%.
Hmm.
That's the current. There's some speculation on what might happen in the future. But anyway, that's the rate as of today. So what that means is that if you earn $100 of capital gains in a corporation, $50 goes into this notional account. Like it's not real. It's a pretend account called the capital dividend account.
Hmm.
And effectively, what that does is that allows you to then pay out a $50 capital dividend to the shareholder tax free.
Right.
Now, again, this sounds like a great advantage. Oh, we should set up a corporation because of the capital dividend account. It's not. All it's trying to do is level the playing field with earning a capital gain personally with a capital gain corporately. Because otherwise, if you have $100 of gain on your Apple stock that was earned inside of your corporation, how would you ever be able to take out the $50 non-taxable portion if not for this notional account? So we track all these things. We track, tax-free life insurance proceeds, among some other things, and that allows us to then pay out that amount to the shareholder.
Okay, that's great. And just a couple follow-up questions. So first, with the RDTOH, in order to get the money back that's accumulated in the RDTOH, when you write yourself a dividend, does that dividend have to be any minimum amount? Like, do you have to hit a certain threshold, or can it be any size dividend and you're going to start to get the RDTOH back?
No, it's just a pure mathematical calculation. You pay it out. I think the ratio is 3 to 1. It might have changed it recently, but something like that. You get back a percentage of the dividends for every dollar that you pay out. It's all a calculation that's done right on the corporate tax return.
Okay, and just with regards to the CDA, maybe I can bring up a few of my holdings to hopefully help clarify a point. So I hold Amazon, which has done well over 2 years, and also Air Canada, which I bought at the absolute worst time, pre-pandemic, but that's life. But anyways, if I was going to sell both those stocks, I would realize a gain for Amazon and a loss for Air Canada, and that would result in a net tally within my CDA. But I guess my understanding is one can only pay themselves from the CDA, issue themselves a capital dividend if that net figure in the CDA is in the positives, right? So in other words, you can have a few bad eggs that can prevent you from issuing a dividend. Is that correct?
That's absolutely right. And that's why one of the planning ideas that we've been telling people this year is that if you are going to do some tax loss planning before the end of the year to crystallize losses, you might want to crystallize any gains first, or at least pay out the balance of your capital dividend account the day before you realize those losses, because those losses will reduce your capital dividend account balance. And if it puts it zero or negative, of course, that limits your ability to pay yourself any capital dividends.
Okay, perfect. And now maybe let's start to talk about the impact of our investment income on the small business deduction. And I guess there are some small business owners for whom the small business deduction may not matter that much because they'll be moving most of the corporate money into their personal hands. So then the small business deduction becomes somewhat irrelevant. But for others, that may not be the case. And I guess in 2019, some new rules were put in such that investment income exceeding $50,000 will start to grind down that small business deduction. So for every dollar in excess of 50,000, the SBD falls by $5. So Jamie, for small business owners who are keen on maintaining that small business deduction, what are some investment strategies? What are some potential workarounds for kind of minimizing the decline in the small business deduction?
Yeah, so we've talked about this quite a bit over the last couple of years, and I just want to make out one caveat. If you do have people listening to the podcast that live in Ontario, it's actually not a concern because Ontario is one of the two provinces that has not followed these rules for Ontario provincial rules.
Hmm.
So in fact, there's actually an advantage in Ontario for earning passive investment income above the 50,000. So I would say that in Ontario, the rule doesn't apply.
Uh-huh.
Nothing to be concerned about for anyone outside of Ontario, though, pretty much. It is a concern. And therefore, what we're trying to do is make sure that we are earning under $50,000 to preserve the small business rate. And the way we do that typically is, basic strategies, things like, not turning over that portfolio every year. So
Yep.
maybe every other year we realize capital gains.
Hmm.
We use equity investments where only 50% of gains are taxable. So it would take $100,000 of realized gains to get the $50,000 of passive investment income. We might look at more sophisticated strategies, things like individual pension plans, where we can effectively move some of our corporate investments into a registered pension plan set up for that professional or sometimes their spouse or partner.
Hmm.
There are rules and restrictions on how that works, but effectively you're moving a pool of investment assets into a separate trustee pension. Therefore, that investment income is not subject to tax in the corporation. You don't get above the 50,000. And then finally, the most common thing we've been doing the last couple of years, of course, is if there really is surplus cash that's really not needed in the corp, we've been funding these permanent life insurance policies, whether it's universal life or whole life owned by the corporation. So
Hmm.
we're taking cash that otherwise is attracting investment income, and we're moving that inside of a corporately owned permanent life insurance policy so that the investment income is now sheltered inside the policy, and therefore the company is not subject to that clawback when they have over $50,000 of passive investment income.
Okay, so some useful strategies there for mitigating the impact of total investment income on the small business deduction. And just a couple follow-up questions. So, when looking at impact of aggregate investment income on the SPD, it's only really 50% of capital gains that are going to count towards the total investment income, right?
Well, that's right, and that's why capital gains are a great strategy in terms of investment income. Obviously, there's risk associated with that, but that's correct. So all our other types of income, including rental income, things like that, are all included in the passive income, the aggregate investment income. But capital gains only 50% is included.
Okay, great. And if you have a capital loss that's been realized, then that should help to reduce the aggregate investment income for the year, right?
It sure would. Yeah, realized loss. That's correct. Yeah. So you got to be careful with when you're taking losses and things like that. Yeah.
Okay, so we've kind of been talking about how capital gains are a useful strategy when investing through a corporation. And on that topic, I'm not asking you to wave your magic wand and make a hard call, but there's been a lot of talk over the last few years about the tax inclusion rate on capital gains rising from where it is now at 50% to maybe as high as 70, 75%. I'm not sure how accurate those numbers are, but there's certainly a lot of talk about that. And it almost seems like with COVID, the writing's kind of on the wall. But that's making some people think that now might actually be a really good time to realize some capital gains. And I mean, this is all a little bit speculative, but I'm just wondering what your take is on this.
Yeah, so I can't predict for sure. I can tell you the climate is right for this type of tax change. If you sort of look at everything that's going on in the economy, if you look at the current government, you look at position statements, you look at minority. Look, capital gains tax has been around, since '71. We've had a 50% inclusion rate for many years. It did go up to two-thirds and to three-quarters and back down again to 50%. That's the rate we're in right now. A lot of debate right now on what is the right rate for capital gains. We know that most people in Canada do do not care about it because they don't pay any capital gains tax because they don't have any money invested in a non-registered portfolio. Your average Canadian has all their money either in an RSP or a pension plan or a TFSA or in a kid's RESP. They don't have non-registered money. They don't have corporations, so they don't care.
Hmm.
Most of the capital gains are earned by high net worth individuals. Most of the gains, I think 90% of gains, are realized by the top 10%. In terms of income distribution. So it is certainly a wealth issue. We know that the government, the Liberal government specifically, has been targeting high net worth individuals in terms of the ability to pay. We've seen that with the increase in the top rate to well over 50% in 8 out of the 10 provinces when you look at federal and provincial policies. So
Hmm.
if the government were to choose an option in terms of how do we more tax people who can afford to pay, they would say, then I think capital gains could be on the table.
Uh-huh.
After all, at the end of the day, this was part of the platform of a couple of the minority parties, and it was something that they were arguing for. And I wouldn't be surprised if we see something like that. That being said, as I'm sure we've talked about or you've talked about before with others, do you sell everything just because you're worried that the capital gains rate is going to go up?
No. Yeah.
Probably not a good idea, right?
Right.
So, you got to be very cautious. That being said, I would look at a portfolio. And if you think that from an investment point of view, that the investment has reached a certain point, what an opportunity now to either diversify the portfolio by making a change or something we haven't even talked about today, consider charitable gifting. The
Hmm.
opportunity to donate the appreciated security to a registered charity, get that tax receipt. You pay zero capital gains tax on that donation. And if it's done within a corporation, there's a secret benefit. You get actually, in addition to your capital dividend account, which we just talked about, which actually allows you to pay out to yourself a tax-free dividend equal to the non-taxable gain later on. So I actually call that a triple benefit to the corporation: the
Yeah.
donation deduction, the tax-free gain on the securities, as well as the credit to the capital dividend account. So there are things that can be done. But yes, we're worried about it, and I think many Canadians are worried about it. It could happen.
Okay, well, let's maybe just talk about those charitable donations because that to me is just something that sounds too good to be true. But it is true, right? So you donate appreciated stock, the capital gains are going to be tax free, and then you get the same addition to your capital dividend account, right? So I guess I guess take advantage of that while you can.
Yeah, I think it's a loophole. I don't know if it was intended, but it's been there for at least 10 years. And I'm telling you that this is what people are doing. Certainly, wealthier Canadians that are getting good tax advice on their private corporations that have portfolios, that's what they're all doing.
Okay, so my next point, I bring it up because questions are coming my way on this topic, and I am not the expert, and it's regarding capital stripping. So, and if you feel like this is not the right medium to discuss it, that's totally okay. But my basic questions are, can you summarize the process for us? Is it worth the hassle and cost for individuals who have significant gains that are to be realized? And do you think this process or this practice is going to be abolished anytime soon?
Yeah, so we usually use the term surplus stripping, which applies to many corporations, including professional corporations, medical corporations, law corporations, etc. The government doesn't like it. They tried to change it a few years ago. They brought in legislation that was then cut back. It was never enacted. We know the government wants to get rid of surplus stripping. So one way they could do it goes back to what we were just talking about, which was increase the capital gains inclusion rate. You
Right.
bump up the inclusion rate to say 75%, then all of a sudden the tax rate on dividends is the same rate as the tax rate on capital gains. They've solved the surplus strip. So, what is a surplus strip? Effectively, it's a transaction that involves a reorganization of your corporation
Hmm.
that effectively allows you, using another company, a sister or a holdco, to effectively strip out, surplus strip the retained earnings of your corporation at a capital gains rate instead of a dividend rate. So if your capital gains rate in Ontario is, I don't know, 26%, and your dividend rate is like 40 or 47, depending on the type of dividends, etc., then effectively you're saving a substantial amount of tax. The problem, of course, is there's professional fees. We've seen law firms and accounting firms, charge many thousands of dollars to do these surplus strips. It
Okay.
adds a bit of complexity to your scenario. We know the government doesn't like it. We think they're going to get rid of it. We don't know how. We don't know when.
Hmm.
But it is a time limited opportunity. A lot of people are doing them. Again, Would I do it for 500,000? No, probably not. The smallest deals we've seen, and we've seen it done with some doctors, particularly in Manitoba, where there's one firm that's marketing this pretty heavily,
Hmm.
with about 1.5 million of retained earnings.
Huh.
They've stripped it out. The downside, as you would obviously guess, is that you're paying tax today versus later on, because you're stripping the money out today, paying tax today, albeit at a capital gains rate,
Right.
versus later on at a dividend rate.
Okay, that's a very helpful summary. Thanks, Jamie. And now, as we wrap up, I want to go back full circle back to RSPs because there's something I really wanted to ask you and I forgot. And basically, so far, we've talked about RSPs as being a very useful vehicle. So if someone has a balanced portfolio, we know that in an RSP, that portfolio will perform pretty well over time, over the long term. And so my question is regarding spousal RSPs. So let's say one spouse has an RSP and that needs to be topped up a little bit. So if we know an RSP is going to perform well for the small business owner, then I guess making a spousal RSP almost seems like a no-brainer, but I just want your take on this.
Yeah, again, let's just clarify the myth. So when you contribute to a spousal RSP, all it is an RSP in your spouse's name, right? So it's based on your room. So you have to have the room and you get to choose. Do I want to give the money to myself, or do I want to give it to my wife, my partner, my husband, whatever? And that's your choice, right? You can give it to whoever you want. The reason why people use a spousal RSP is to do income splitting effectively in retirement. So effectively, what allows you to do is you really have to go back to your financial situation and do a prediction of where you think you're going to be in retirement. What is all your sources of income in retirement, and what is your spouse or partner's income in retirement? Now, because we have progressive graduated rates in Canada, the idea is to have as much income in equal both persons' hands, so that you pay less tax. If it's all in one person's hands and you're forced to take money out of a RIF when you convert an RSP after age 71, then that's just added to your income. If you're a high income earner and your spouse or partner is a zero income earner, yes, there are ways to do pension income splitting, but you can only do that with 50% of your income. With a spousal RSP, if every year you've been taking the money and putting it into your spouse or partner's RSP, effectively they can then take the money out and include it in their income, 100% of it, as opposed to just the 50% pension income splitting limit. So we're big fans of spousal RSPs. We think that if you're in a scenario where your spouse or partner has low or minimal expectations of retirement income or assets, then absolutely we would go with 100% spousal RSP contributions.
All right, I love it. That's great. So, Jamie, that basically wraps it up. You've covered a lot of ground for us in just 30 minutes. And in my mind, if there's somebody out there who can offer timely tax advice to incorporated professionals, I think you're that person. So, thank you very much for taking the time with us today. It was very useful.
My pleasure. Thanks.
Okay, let's establish a few take home points from today. So, income splitting, while we know it's harder now than it was before, it is not dead. So, if you are a baller unlike myself and are sitting on a fat stack of non corporate after tax cash, then by all means go ahead and take advantage of that prescribed rate loan. It's an all time low interest rate of 1%. Go ahead, loan some of that love to somebody in your family if they're at a lower marginal tax rate. Okay, so the models, the research basically show that for a balanced portfolio over time, it will probably perform a little bit better inside of an RSP than compared to a corporation. And to understand that, it's because different types of income, like capital gains, interest, dividends, whether they're foreign or domestic, they have a similar tax treatment inside an RSP, whereas tax treatment of these entities differs within a corporation. Okay, and if you're investing through the corporation, then just recognize that capital gains have preferential tax treatment. And in fact, a portfolio focused on deferred capital gains will probably perform better in a corporation over the long run than compared to an RRSP. And next in line for preferential tax treatment inside a corporation would be Canadian dividends. And while we're on this, let's just address a point that Jamie raised, which is a great point, in that paying yourself Canadian dividends earned through the corporation on an annual basis can be a tax efficient process. Now, part of this is due to the fact that the initial tax hit on the Canadian dividend is refundable to you when you try to move the money personally. The rest of it is a little bit more complicated as to whether you can pay yourself an eligible versus ineligible dividend, so maybe something to best discuss with your accountant to see if this is the right thing for you to do. Just remember, there can be a slight tax advantage to funneling this Canadian dividend income to yourself personally, particularly if the main reason you're investing in the stock is for the dividend income. And remember, while I'm not telling you to avoid investing in foreign stocks that pay a dividend, just recognize that the tax treatment of foreign dividend income when earned through a corporation is not favorable. Now, what's not too complicated is the fact that you have many tools at your disposal to limit the effect of corporate investment income on the small business deduction. This includes things like RRSPs, independent pension plans, donating to charity, and the ultimate no-brainer of all, the tax-free savings account. And remember, you can also buy and hold your equities. Okay, and finally, if you enjoy listening to the podcast, please don't hesitate to subscribe and to spread the word to anybody else who you think could benefit. Until next time, stay safe and stay savvy.